If the idea of taking money makes you uneasy, owing people, reporting to them, or dealing with headaches that come with it, you're not wrong to be cautious. This episode isn't about convincing you to raise money. It's about helping you understand when money helps, when it hurts, and how to avoid deals you'll spend years unwinding. This is going to be something that I think a lot of people, especially right now, are looking at, considering, or already on that path. And this will help them figure out if they're going about it the right way. So I want to thank you so much for your time.
You very much for inviting me on and giving me the opportunity to share with your audience.
Let's start here because this matters for people who are raising money and people who are deliberately avoiding it. Why is funding not a growth decision first, but a risk decision?
Yeah, so let me address the first part of the question. Funding is not a one-time scenario, right? As your entity grows, you're going to need funding more than once. So, you may need funding at startup. You will probably need funding once you get some traction in the marketplace. You may want to take your company public. There are lots of things that you could do with your company as it scales. All of these require funding, right? So funding is never a one-time event. It's always going to be a multiple event, and everyone requires a different decision criteria, right? So in terms of the risk versus growth issue, is that the easiest way to get funding is to understand the deal you have and to
Mhm.
match the deal you have to someone predisposed to do the type of deal you have, right? So
Yes.
where you run into a risk is and where a lot of entrepreneurs incur a lot of risk is that they undertake the funding process not understanding how funding works. And so they waste a ton of time talking to people who are never going to do the deal they have, right? And
Yes.
what happens, and this is where the risk comes in, we can't get back time. It's the most precious resource we have on earth. And if you waste a lot of time when in scaling a business, you don't have a ton of time. You have to make decisions really quickly because things happen dynamically. And if you
Mhm.
waste a lot of time, talking to the wrong people, pitching the wrong things, and then ultimately you don't raise capital, well, you may not be able to recover from the time you've lost, right? You may do so much damage to your business that you can't recover. And so it's not a mystery that when you see studies that say, hey, 80% of all small businesses fail within 10 years. And then when
Mhm.
they drill down and talk to the entrepreneurs who failed and say, what do you attribute your failure to? At least 50% of the reasons why have something to do with raising capital or finance,
Mm.
right? And so that's the huge risk. It's, if you waste a lot of time doing things that ultimately could be corrected if you understood how fundraising works. You avoid, the potential of losing your business and having to start all over again. And when you do that, you're more than likely going to have to do it with a completely brand new venture. It's rare
Yeah.
that you're going to be able to, you know, uh, um, resurrect something that's gone south.
Yeah. Yeah, that's true. It's something where it kind of goes back to what we were talking about before. I was saying damage control is trying to undo damage that's already been done. And I don't know that you can do that, especially when it's to your reputation. And once someone has a sour taste, they normally don't let that go. I would say growth versus risk for me is those are just different stages. Like there are some people that may be early stage that are thinking about the risk. There are a lot of risks that come along with looking into funding, but you highlighted a risk that I don't hear a lot of people talk about, and I love that you unpack that is there's the risk of not understanding what that process looks like and who to have that conversation with. We both joked about having to block people because they called us about loans and funding, and it's one of those things of how can you offer me something when you have no idea what my circumstances are, or what my situation is? It just automatically lets me know that it's so impersonal that that's the type of person that I do need to avoid, because if it's impersonal now, it's gonna be impersonal on the back end, and you don't care about what my situation is. You're giving me money, and you're gonna have expectations on the back end that probably don't align with what mines are. I think that's a great, great point.
And I'm flipping to the sales aspect, but
Mm,
this is in relation to what you're talking about. I'll tell people, and this is having spent the first 11 years of my career in sales with Xerox and AT&T, salespeople, we tend not to trust salespeople. And the reason why is because we don't understand what their motivation is for selling to us in the first place.
Mhm,
So, and then I'll flip this and say that, understanding how salespeople think, salespeople, so there are always two scenarios. One is, a salesperson could take the time to understand what your pain points are, understand
mhm,
you, how you're affected by whatever circumstances you're having. And so what they've done is, as a result of having done all that research, they've matched your problem to a solution that they can provide to help you overcome your obstacle. That's going to be incredibly rare. That might be 1% of the time. The other
yeah,
99% of the time, you know, if you let me interview the person that's trying to sell you, I guarantee you I'd be able to discover that whatever it is they're pitching to you, it's the thing they're being most highly compensated for, and that's why they're
yes,
pitching it. They're framing it as if you need this, but
mhm,
in essence, they could care less whether you need it or not. It's just they know how much money they want to make this year. This product is getting them the highest commission. They're pitching this product, excluding everything else, because this gets them to where they want to go fastest, right? And so that's
mhm,
why the pitch. And customers understand this, and that's why we don't trust salespeople. So that relates to when you're talking about investment companies reaching out and say, "Hey, I want to give you a loan." Well, I didn't apply for one. So, it's like you
yeah,
obviously didn't do the research to,
yeah,
I really wasn't in the market and had a need for this. Why are you pitching to me? I'm not your ideal customer. Clearly, you don't have my best interest at heart. And unfortunately, there are going to be some people that get taken advantage of. I feel sorry
mhm.
for those people.
Yeah, I think a lot of that goes back to urgency. Like, if they can catch you in a moment where they feel like you need a lifeline, then you're probably gonna ask less follow-up questions, and you're probably gonna look at it as something where I need this, and that's where some people can end up getting themselves into trouble. That's one of the reasons why I thought this episode was gonna be something that more people could not only benefit from now, but come back and watch it when you know that this is something that you're considering more seriously, and we're gonna cover things that will help you understand what it is that you're looking at. But yeah, just off the cuff, I'm more of an account manager. I wanna work with people after they realize what they invested in, so I'm less of a salesperson, but we're both veterans in a way to be able to say, "I remember doing sales, and when I did sales, you not only sold it, but you managed it." Now it's a little bit different where, you can sell something and then they hand it off to someone else. They don't have to deal with any of the ramifications of what they sold someone on, and that's where I run into issues. So yes. When I was listening to what you were saying, I thought about it almost being more dangerous to me if I talk to someone that I know that they have their own sales goals and they have their own thing that they're selling, and they actually took the time to figure out what my situation is. Because then it's undeniable. Like anything that you're telling me, it's you've done your research to be able to say, well, I mean, Sean, you may want funding because you want to be able to do this, 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 and this. Then it's not something where I can kind of brush that off. It's because they did their due diligence that is someone that is probably I imagine their close rate is higher, but it's still gonna be that 1% because there aren't a lot of people that wanna put in that same level of effort. There are probably gonna be more people that wanna test and see, can I catch you at a time where there's urgency so I don't have to okay.
Distract us with the sales conversation. I know this is a
No,
conversation
no.
about finance.
No, no, no. This is something that people need to understand because it's still a business. And they're in the business of lending money, but they're also in the business of making money back. And it's not one of those things where they're breaking even. It's not like you go to a friend or something and you say, listen, I need to borrow $20. And the friend says, okay, well, I'll give you the $20. You give me the $20 back when you have it. Giving you that $20, but they're expecting to get 25, 30 back. And you have to understand that going into it. So when you know that you're being sold, then you can go into it with the mindset of, I don't need to wonder about what your agenda is. I need to ask the questions that help me understand, does your agenda align with my agenda? So I love that you brought that up because I think that's really, really important. With that, I would love to talk about debt versus equity because that plays into it a bit. A lot of people lump all money together, but the obligations are wildly different. That's something where there's good money, there's good debt, bad debt, there's equity. I think there's blurred lines there. People don't necessarily understand it. I see a lot of stuff online where people will say, "Oh, well, this person's doing this. They must be broke." And it's you don't understand the loopholes that people can work. That's why there's such a big gap between the people that are old money and have been wealthy and have had it forever, and the new money where they have to figure out how to be able to manage it. So I'd like to start with, for someone who's uneasy about funding, what's the non-obvious difference between debt, equity, and that actually matter in the day to day?
Yeah, basically the difference between the two is debt is, just think of a loan. Debt lenders are usually commercial banks, could be a savings and loan or a credit union, but it's, you in essence, you're getting a loan or a line of credit, right? Um, and equity, on the other hand, is you're giving someone a piece of your business. So you're selling stock in your business to someone for the money that they're giving you, right? So that's just the basic difference. Debt obviously is preferable if you can get it, because you're not giving up equity in your business, right? But what you're losing is advice, right? So
Mm,
there's always a talk about dumb money and smart money. So dumb money
yes.
is when someone just gives you money, right? And nothing else, right? And you're going to give them back their money plus a return at some point.
Hmm.
They've done really nothing to help you with your business other than give you money. Smart money, on the other hand, is not only am I going to give you money, but I'm actually going to give you advice because hopefully I have business knowledge that I can share with you.
Yes.
I have hopefully a network, and I can connect you to a network where I can hopefully help you get customers. I can help you get suppliers. I can help introduce you to complementers. I maybe even be able to structure some partnerships with competitors, right?
Hmm.
Hopefully these are competitors that are so large they don't view you as a competitor, and
Yes.
they allow you to take advantage of the fact that you as a small business are incredibly nimble, and no, you don't have to ask anyone for permission to do anything. They're
Hmm.
going to leverage their significant marketing dollars to identify leads. They're going to feed them to you. You're going to execute on those leads and close on those leads, and you guys are going to split the revenue. So, smart money is going to introduce you to all these types of resources in addition to giving you the money. So, you always want smart money, ideally. And again, debt typically is going to fall into the dumb money category. I can't think of many cases where you're going to get a loan from a commercial bank and they're going to provide advice to you on top of the fact that they're giving you a loan. It's a transaction for them. Okay. And so the in terms of debt, again, it's ideal to get debt because you're not giving up any equity in your company. So you still own
Hmm.
100% of your company. It can only be gotten if you can show one of two things. You either have to show revenue,
Hmm.
excess revenue in your business to be able to make the loan payment. So if someone's going
Yes.
to give you a loan, it's going to come with a monthly payment. And you have to show in your financials that, one, I already have customers who are paying me
Hmm.
money, and I have enough net profit to be able to pay that loan monthly payment amount, whatever that is. And if you don't have that, you have to collateralize the loan, or what's called collateralize the loan. You have to show them assets, liquid assets, um, that you will pledge against the loan, so that if you default on the loan, they're going to take those assets, sell them to get their money back, right? So you'd have to have a home with equity in it. Uh, you would have to have a bank account with the amount of money you're looking to borrow, something that they can seize if they're not going to do this right away, but you're going to pledge it so that
Hmm.
they don't have any problem going to the courts and saying, hey, this person isn't paying the loan payment. We want to call this loan in, and they pledge this asset. We want this asset so that we can sell it and get our money back. And the court will allow them to do that. That's if you don't have one of those two scenarios, free cash flow to make the loan payment or the collateral, the liquid assets to collateralize the loan, you're not getting a loan, right? So debt's not an issue if you don't have one of those two scenarios.
Hmm.
So everybody wants debt, but again, if you don't have one of those two scenarios, you're not getting debt. So don't even waste your time going down that path if you don't have one of those two things.
Let's unpack that for a second because there's going to be some early stage businesses that will hear that and say, well, how do I get that startup funding? If does that mean I have to be able to put my house up or something where it's that level of collateral? But it also goes back to what we were saying in the previous episode of having a business model where you're saying, this is how much I'm generating, but you can also say, this is how much I plan to generate. And if your business model is sound enough, then it does open the door for you to be able to get further into that conversation. I'm not going to promise that you'll get the loan, but it does get you further into that conversation with someone saying, okay, well, you've thought it out well enough for me to be able to consider you in ways that if you just came in and said, I need a loan, that's not going to get you the same thing.
Yeah. So this is where, and again, it ties into what we talked about in the first session. This is where planning comes into play. This is why you want to plan in advance, right? And build and write a business plan. Because if you knew that basically your business plan, and this will tie into this section, the financial section of your business plan is going to tell you how much money you need, right? Because when you're projecting revenues and expenses into the future, what you're looking at and how much money you need is basically the cumulative amount of monthly losses you're going to incur until you reach break-even point when the business can fund itself. Revenues are more than your monthly expenses, so that the cumulative amount of your losses are the amount of is the amount of money you need to raise. You might increase it a little bit so you have a cushion.
Hmm.
Your financials will tell you that. If you said, I needed to raise $100,000 before the business is going to be to a point where I need to make money, you have options now, knowing that in advance. So you obviously can apply for a loan. But again, if I don't have 100,000 in liquid assets to collateralize, or if I can't show, that $100,000 loan, let's say it's 10-year term, uh, 5% annual interest.
Hmm.
It's going to be, let's say, $1,000 a month. Well, if you're not showing excess cash flow of the $1,000 a month in the business to be able to pay that loan, make that loan payment, again, you're not going to be able to get a loan. Does that does that mean you stop there? No, because there are other things you can do. If you've planned this in advance and you know all of this, what else could you do? Hopefully, you have a job before you start the business. Well, maybe what you do is, while you've got this idea for a business, you've written a business plan, you need $100,000, you'd like to get
I
a
see where
loan,
you're going with it.
you know
Yeah.
that, you're going to have $1,000 monthly loan payment. Well, what I can do is I can start saving money to be able to have money in an account, ideally with the bank I'm trying to get a loan from, because now they have a vested interest in helping you, right?
Hmm.
To say, okay, well, if I've got X amount of dollars in my bank account and I'm trying to get a loan for you for $100,000, well, I'll collateralize my savings or checking account. But I've planned several years in advance, or however long in advance it takes you to build up the capital in your account to be able to justify that. What else could you do? Well, I could find a co-founder to work with me, and maybe either me or my co-founder continues to work in our corporate job. So now one of us is in the business full time, but the other person's still working.
Smart.
So now we apply for the loan. How are you going to be able to pay this $1,000 a month? Oh, well, my partner or I have stayed in our job, and we're making 50,000 a year, so we have 1,000 a month in free cash flow. We'll pay it personally
Hmm.
until the business scales to a point where the business can take over the payment. So there are always options.
I love where you're going with this, mainly because it's opening the door for different conversations and people that I know that would be at different stages. There are going to be some people that would say, "Well, why would I put that money aside? If I had the money, why wouldn't I spend that money myself?" And the answer to that in a lot of situations is because that's where you get your cushion from. That's where in some cases, some people get business insurance and things like that. But if you know that you need $100,000 and you put 50,000 aside, then you have that 50 and you have that 50 that you can get as a loan. And you're listing that 50 as collateral, but you're also doing with the expectations of, I feel like I'll be able to cover it with what I'm going to be able to bring in. So sometimes you're not giving them that as an option to say, well, take this if anything goes wrong. You're saying, strategically, I'm gonna ask for half of what I need, and I'm gonna save up the other half. So this way I can go into the market knowing that I have some of those things in place. And then also, I love what you covered as far as being able to hold on to the job.
Yeah, yeah,
Again, that's planning, that's thinking ahead and taking preventative measures and making sure that you don't have to be the hero in the story. Sometimes it's good to be able to have a partner and you just have to structure things in a way that makes it sense. But all of that goes back into having that conversation with the banks and knowing what it is that you're actually trying to accomplish. Everything that you're covering, I think it's covering different stages and people that would have different questions. And you're covering it from angles that sometimes people don't even get to hear. So, one, thank you for that. And I think it's really important for people to understand that, like, you're giving the other options besides just going, okay, well, I can't afford the loan. Okay, well, you can plan ahead for it. And either you put certain money aside and say, well, I'm going to do this, or it also will help you with your business model, help you with your business plan. If you know that you're going to need a certain amount of money, then you need to build a business model that's going to allow you to be able to make those monthly payments. Because if you can show them that you can make those monthly payments, for example, when I first started my business, they said, "Well, how much do you expect to make?" And I said, "Well, on average, if I charge at least $1,000 for a website, and the monthly payment that I have to give you is $500 a month, then all I need is one client, and allow me to be able to make money, and allow me to make sure that I have the money to be able to give to you." And the real difference in that I think people confuse is the difference between revenue and profit. And I think that's the thing that trips some people up. So it's revenue is what you may generate, profit is what you're going to have on the back end after the business expenses and everything else. What we're talking about is, yes, that's also part of the revenue or the business expense that you may have, but typically, and correct me if I'm wrong, you're probably paying that out of the profit that you were supposed to get. Okay.
yeah.
Because I
And
know
then
there are people that don't they'll think, well, when I sold something for this amount of money, I made this amount of money. And it's like, no, that's not really how it works. Sometimes as an entrepreneur, you don't start paying yourself until you're into your business for a certain amount of time. So it's setting that expectation of that's what it looks like when you get that kind of loan. And that's why someone may ask for a loan. Even if you have the money, why not have the bank help you establish your credit and some of the rest of those things where there's good debt, bad debt, equity, and stuff like that. So I apologize for interrupting, but when you were saying it, it was making me think of different people I knew I had conversations with, and I wasn't going to be able to explain it. So you're welcome. I got someone on here that can answer your questions, and this way you've got an answer that don't take my word for it. Take it from someone that's actually having these conversations with people all the time.
Yeah, and then on the debt side, there are also I mean, you've got grants, there's
Mhm,
so many. I mean, there are grants that you could get, federal grants that you could potentially get. There aren't a lot of these resources out there, and
mhm,
they're very specialized. There are on the smaller end, there are organizations that will lend, say, up to $5,000 to an entrepreneur, but it's basically a pool of entrepreneurs who are lending to each other. So one person gets five, as that person pays back with interest, it increases the pool to be able to
yes,
lend to someone else. There are organizations like that. What else? You can do something like when I started my final tech company, we got a line of credit with a bank, where
mm,
as we had gotten a contract. We hadn't started the contract, or we hadn't received any funding from the contract yet, but we had received a significant contract with one of the largest school districts in the country, and then that got
retail
announced
office,
and
yeah,
publicized, and magazines and newspapers and all that good stuff. When the bank heard about that, read about it in, I think, the Philadelphia Business Journal, they actually reached out to me and asked if
of
I wanted
course.
money. I didn't need money at the time, so I was hesitant, but
Mm,
the more they talked to me about it, I was like, and they framed it in a way that I almost couldn't refuse. It ended up being a line of credit, and it was at such a low interest rate, and the terms were so favorable. It basically
mm,
was, they were charging me like 2.5% interest,
nice.
and I didn't. The interest didn't accrue until 30 days after I drew money down. And so
Okay.
I was able to, there was one particular healthcare customer that I had that was looking for ways to do business with me. And so when I got this line of credit, initially they gave me $100,000 line of credit. I went to this customer and said, I think I know how we can expand what we do.
Nice.
I know you're a Dell shop, where at the time we were buying all of our servers from Dell Computer.
Mhm.
So I had a relationship with Dell, and I said, I knew that this healthcare organization bought a lot of Dell equipment, and I said, well, I know you buy a lot of equipment from Dell. I don't resell equipment. I wasn't in that business, but I said I would actually be willing to, buy your Dell equipment for you through a contract as long as, you didn't beat me up on price. And so they agreed to allow me to get a certain margin on the sale of computers and software
Mm.
that was better than the industry average. And then, as I said, I didn't get interested in the crew until 30 days after I drew money down. So I asked the customer, and again, I was a new business, relatively new. So I said, do you think it would be possible to pay me in 15 days? And he said, absolutely. I was talking to the chief financial officer of the organization. He said, absolutely. He said, you're a new business, and we like to help local new businesses out, and so yeah, I think we could prioritize paying you in 15 days. Okay, perfect. Yeah, I said next time you make an order, just call us up. We'll place it through Dell, and and all this good stuff, and so that, basically they started buying equipment through us. Basically, all of what I've described is called arbitrage. It's
Mm.
buying at wholesale and selling it at retail, right? So it's you're just playing with, timing and interest
Mhm.
differences in money. And so what I was able to do is buy equipment for this large vendor, um, through, from Dell, and use this line of credit to pay for it. I had everything shipped directly to the customer. And once they received it, they paid us. Because they paid us in 15 days or less. We never accrued any interest on the money we were drawing down.
Yeah.
What ended
Yeah.
up happening with the bank was they were like, well, wow, he's flipped this $100,000 line in the first, say, 6 months, like 7 times. I was like, Jesus Christ, how is he paying this back so fast? So
Yeah.
in their mind, it was like, well, if we give him more money, he won't be able to pay it back as fast.
Eventually, yes.
They kept increasing the line. So it went from 100,000 to 250 to 500 to a million. And then I actually reached out to them. I'm like, I don't want any more money. Don't increase this line again. But it didn't matter how much they gave us. We still flipped it as fast as we did before because I had agreed with the customer to pay us faster than we had to pay the money back. So, yeah. So they're all,
I love that. I love it because there's things to unpack in that. One, the return time on how to be able to make sure that you stayed ahead of when that loan was kicking in, or when you tapped into that actual, credit line. So, knowing that it's 30 days, you plan things out for 15 days. So,
yeah,
even if they were late, you were still ahead.
yeah,
So,
yeah.
when we're talking about being strategic and thinking things through, those are the types of things that you wanna be able to if you do it right, you never actually touch your money. And it's almost to the detriment of the bank because they're thinking at some point you're gonna trip up, and you didn't trip up because you planned it out that well, and I think there's real power in it.
And you had also asked about the on the equity side. On the equity side, the players are really you've got crowdfunding, you've got
Mm.
angel investors, you've got venture capital, and then private equity. Private equity, for the most part, is those are large institutional organizations, hedge funds, so on and so forth. That's not going to be accessible for the average entrepreneur. So you really, for the average entrepreneurial business, you're talking crowdfunding, angel investors, and venture capital. And so on that side, again, you're giving up some of your business. So what you've got to look at there is who are the people that make up the investor pool in that industry, and what do they want back? Because that's basically how you determine who you should be talking to. I can't think of a deal where it would be ideal to pitch to all three of those pools at the same time.
Mm.
So we'll start with venture capital. Venture capital, these are MBAs from top tier schools for the most part that work at these organizations. More than likely, they majored in finance. They'll know more about finance than most people will ever know about finance. So your ability to negotiate a good deal is not good. And venture capitalists typically, while there are micro venture capital firms that will do deals less than 10 million,
Mhm.
say a million to 10 million, there aren't many, so
Mhm.
you're really talking if you're looking to raise 10 million or more, and you have the capacity in your financials to be able to repay them 10 to 20 times the return on their investment over 5 to 7 years, venture capital is ideal. So
Okay.
you're going to talk to venture capitalists when you've got lots of traction, your business is already well along the path of scaling. And now it's okay. We need to raise $100 million, $1 billion to go public or whatever.
You're
You're
venturing into new niches, you've already established you're past the growth stage, and you're
right.
at the point of expansion to new areas where it's already proven, but the moment you tap into that new audience, that's where you wanna be able to have that extra
Yeah, yeah,
funding coming in, yeah.
yeah. Now like I said, there are venture capitalists that will do deals with startups that are pre-revenue. The problem is, you're going to give away your company, right? Because you at that point, with no market validation, you have no negotiating capital, right? So if you want a million, 10 million, whatever the case may be, you might be able to get it, but you might be able to get it at terms that you're not going to be comfortable living with,
Yeah,
right? Because
yeah.
more than likely they're going to at least take 51% of your company because they're going to want to control it and control you and control what happens in the company to ensure that they are able to get back their money at the rate of return they want in the timeline they want it, back.
It kinda goes back to smart money, yeah.
Yeah, yeah. On the angel investor side, angel investors are traditionally they're just wealthy individuals, right?
Mhm.
Th- There are there are angel investor groups, but again, they're typically groups of wealthy individuals who invest together, and so while they might have an advanced degree in finance, more than likely they don't. They've been in your shoes. They've actually scaled and exited from a company and done very well doing so. So they've made a lot of money. Excuse me, and now they want to invest in other businesses as a way to continue making money. So that's what they bring. So they're clearly going to have connections, resources that they can bring, and
Mhm.
knowledge as well as money. And so your ability to negotiate a deal with them is better than it will be with venture capitalists.
Let me pause here because this is gonna be one that there are gonna be a lot of people here venture, and they're saying, "Well, clearly that's not for me." Angel investors, there's tiers to it, and
Yes.
there's gonna be different ways for you to be able to look at it. So this is one that I wanna unpack a little bit more because I think this is something where I actually have friends where they put money aside and they're like, "I don't wanna run a business." That's okay. You can invest in a business,
Yeah. Yeah.
and as long as you structure right, you find someone that has good ideas. So when I think angel investors, I think instinct investing. So it's these are people that have good instincts to say, "You know what? You've got a good idea, and I think that's gonna go somewhere." So there are the people that are very high up, and yes, you may be able to go after, large sums of money, but then there are also people that are gonna be lower tier that wanna be in a game, but they don't wanna be in a game, and it's finding the people that are willing to be able to do that. So I would love if you can go into that a little bit more because I think that's more of a pocket for people that are gonna be, smaller businesses that are trying to figure things out, but this is gonna give them a little more negotiating power and understanding of who they should be having a conversation with.
Yeah. Well, if you're the entrepreneur trying to raise the capital, you got to understand that even though it's an angel investor, they might not be the sophisticated finance mind. They are smart because more than likely they've been able to accumulate this capital. So they're clearly smart enough to be able to do that. And you also have to think when an investor has options, like if any investor has 100,000, 500,000, $1 million to invest, they have a lot of options on where they can invest that money, right? So they can invest it and they could invest it in an exchange traded fund that matches the Standard and Poor's 500, where they're pretty much guaranteed to get a 10% annual rate of return because that's
Mhm.
what the stock market has gotten since the stock market was created. You know, uh, they could invest it in treasury bonds and get a 7% return on their money over a 20-year period of time, right?
Mhm.
They could invest in small business stocks. They can go to NASDAQ, the NASDAQ exchange, and just trade on these are called pink sheets. These are all these small companies, startups, just like, say, your or my company, but they're trading publicly, their stock. and they can go there and invest in a company. So there are lots of alternatives that they have. They have a pretty good idea of what their rate of return is.
Mhm.
Investing directly in your company is the highest risk of anything they could invest in. So you have to know if they invested in any of these other things, what's the potential rate of return? Whatever rate of return they can get from all these, whatever the next riskiest thing is, and that the rate of return tied to that, you have to exceed that as the small business owner trying to get capital from them. Otherwise, there's no incentive for them to invest in your business versus putting it in something less risky with a higher rate of return than you're offering to give them, right? So
So let's unpack that a little bit more. So technically what you're saying is if you understand what the safe risk is and you understand what they've already invested in, these are some of the questions that you may want to be able to ask someone to say, well, if you're an angel investor, as a follow-up question, well, why aren't you going with something that's more stable, something where you have an expected return? Like you said, maybe stocks is something where it's 10%, or in this, it may be another percent or another percent. Like that gives you a way of being able to have a conversation to kind of feel out that person to understand maybe they're just in it for the risk. Maybe they want that, that risk game of being able to say, well, I found something in this person and I feel like they're going to be able to get something back. There are a lot of examples that people have out there, for a lack of a better way to put it. Some things like Shark Tank are out there where they're looking at someone that says, you know what, you have a good enough idea. I didn't have to come up with the idea. You already figured out the business model and certain parts of it. So now it's really just a matter of, do you have someone that can back you up and someone that can bring you into rooms that you can't get into? And once I get you in the room, are you going to be able to hold your own, or am I going to have to hold your hand through the whole thing? And that's what I'm hearing and what you're saying of being able to have that conversation. So if you're on the entrepreneurial side, those are some of the things that you want to be able to ask so you understand what their situation is and how smart are they with their money. Because how smart they are with their money is also going to dictate how smart they're going to be with your money and what kind of connections and things that they have, how invested in you that they would be. And then from the people that have put some money aside and you want to start looking at potential businesses to invest in, those are the types of things to be able to think about. If you're not willing to risk a certain amount, then you just laid out different things that they can invest in that will give them something where it's less of a risk and they can just kind of run with that. But if you do want to be able to invest in someone else's business, now you have a better idea of some of the expectations that you need to go in.
well, Shark Tank is great. You brought that up because I think it's very instructive for entrepreneurs that are looking to raise
Mm,
capital. I always advise them to look at shows like that. There's forget the name of. There's another show with Marcus Lemonis
mhm,
where he's going out and helping entrepreneurs turn businesses around. You know, when you watch, all you have to do is watch one episode of Shark Tank. One, these are angel investors, right? So these
mhm,
are successful entrepreneurs in their own right who they've exited their own business, sometimes multiple businesses, and now they're looking to invest in other businesses. But take note of the questions they ask and in the order of which they ask them, right? So almost always, the very first question they will ask, very first series of questions they will ask are around finances,
yes.
and because they want to understand what kind of traction you have already, right?
Hmm.
And they're looking to understand the financial model of your business because at the end of the day, an investor wants a return on their investment. That's what they are most interested in. And if you don't meet whatever, and every investor has a criteria for what they're looking for in terms of rate of return. The point is, you've got to find out what that is because
Mm,
if you don't meet that, you're not getting money from that investor. So, and it doesn't matter how great the opportunity is, how great you are. It's if you can't give someone what they want in return, you're not getting money from them, period. So rate of return is the first and most critical thing that an investor is going to look at.
mhm,
And then once you get past that, you've met that criteria. Then the next question they have is, to themselves is, can I trust this person to actually deliver on getting me back
yes.
this rate of return?
Yeah.
So they're going to look at you and they're going to look at the people you surrounded yourself with, your team. Can they deliver on the promise of this idea? When you've met that, now they want to look at the idea.
Hmm.
And basically when they're looking at the idea, they want to understand, are you solving a problem? And are customers willing to pay for your solution? right? That's where the market traction comes in. Do you have
Yes.
customers? Do you have agreements to buy from you? Once you go on the market, if you haven't gone to market yet, but there needs to be some validation that you've actually solved the problem that people need help solving, and they're willing to pay for it. Otherwise, it's just a great, it's just whatever, hobby.
Yes, yes. I want to pause there for a moment because you covered things that I think are really important. One, you put things in order. You can tell who you're dealing with when based on a series of questions that they ask. The people that are checking their finances first, character second, and then your business idea after, you kind of have an idea who you're dealing with. If they are someone that is doing a character assessment and they've kind of bypassed the financial part, maybe they already did that math in their head and they already have an idea of what they're willing to risk and what they think they're going to get in return. But there's an order to these things. And if you do not pay attention to that, then it's not only something that you may feel like, all right, well, I moved past that. Maybe they moved past it without asking you the questions because they already felt like they had the answers. But that's something for you to pay attention to as well.
Yeah.
You have to be able to pay attention to those things. Yeah.
So the probability of you raising capital from the first person you approach is almost zero, right?
Mm,
So I tell entrepreneurs the first time you're pitching to someone, I want you to focus less on the pitch and I want you to focus more on the behavior of the person you're pitching to.
that part.
So they're going to tell you up front, hey, I need a business plan, I need a prospectus, whatever. So you're going to have prepared that. You're bringing that to the meeting. You hand that over to them. I want you to observe what's the very first thing they do. So you put a business plan in front of them, and I can guarantee you what an investor will do. They'll flip right to your financial page. Why do they do that? They do that because by looking at your financials, they can do a calculation in their head to determine what rate of return you're offering them for, they can see how much you want, when you're going to be able to repay, and based on the free cash flow you have and your
Hmm.
projections, if you took a reasonable percentage of that free cash flow and repaid them, what rate of return they'd be able to get. So they can do an ROI calculation literally in seconds just by looking at your financials. Now they can determine whether or not this is something worth their time, right? And so I tell entrepreneurs, if they've already figured out that this isn't a deal they do, they're doing you a favor if they throw your business plan in the trash and tell you to get out of their office. Because what they're
Yes.
doing is they're saving you time. They do you a disservice if they sat there and let you pitch for a
Leading
half
you on. Yeah.
hour, wasting your time, knowing they were never going to do the deal in the first place. So, as fearful as we are of hearing no, sometimes no is good, particularly when it comes early, because it saves you time. Now it's like, okay, what you want to find out is why aren't you interested in doing this deal?
Yes. Yes.
Because it's educating you about the marketplace. Okay, well, maybe this type of person isn't the person I need to be talking to in the first place. And
Hmm.
and to be honest with you, again, if you do all this preparatory work we've been talking about, you would never have set up that meeting in the first place. So, yeah,
Yeah, I love that you're covering it this way because what we're really talking about is checking the boxes. And if you don't know what boxes to check, then
yeah,
you
yeah,
need
yeah,
to think through the plan and who you're having these conversations with
yeah,
because I know how many times I've gone into situations and the first thing that they do is they flip over to the finances.
yeah,
Because the finances aren't just them looking at how quickly would you be able to return the funds. It's okay, even if you were able to give me that money, what's going to be left of you? Am I going to be the bloodsucker that took your money and bankrupted your business? Because I don't really get to put what I used to laugh about on the corporate side is how many logos can we put in a presentation? And when you're talking about angel investors and certain people that are building their name based on the businesses that they built, then that's something else that they consider. So it's not just a matter of can they get paid back. It's what are you going to do with the money and the opportunity that I give you? Because every time I can show that I was able to pick a diamond in the rough is something that adds to my credibility and allows me to be able to do more of what I want to be able to do and get better people that want to be able to make those presentations. And that's why we're looking at things like Shark Tank and things like that. We see the people that get thrown out right away. And it's because what they had was a good business idea, but they didn't have a good business opportunity. And those are two completely different things. So I love the fact that you're talking about if someone shuts you down early, that's one of the best things that could happen because then you know, okay, well, where did I lose you? And that's the question that you're really trying to ask. Because that's what gives you the boxes to be able to check and go, okay, well, last time I didn't have a good business plan. When they flipped to the financial side, I didn't even get a word out of my mouth before they were like, yeah, this doesn't seem like it's going to work. Now you know where to spend your time. And then once they go past that part and then they start to ask you about everything else, like you said, then it may go into the character assessment. What happens after you're able to pay us back the money? And then it goes into the business idea and the business opportunity. So understanding those things is letting you know what phases that you need to be able to cover because these are the boxes that you need to check. And if you can check those boxes, great, then you get further through the conversation. If you go in and you hit a wall, don't just feel broken down or like, oh, well, it didn't work for me. Take note of what didn't work and ask the follow up questions when you still have that audience to be able to answer those questions because that is going to arm you for life, not just that moment, but for life.
And then the last category is crowdfunding.
Mm,
Crowdfunding is I tell people think of I'm going to raise capital for my business from my next
mm,
door neighbors.
yeah.
Anybody could invest in a crowdfunding campaign. There are multiple crowdfunding platforms on the internet that you can go to, and you basically create a campaign to raise capital for your business.
Hmm.
The beauty of crowdfunding is you can raise an unlimited amount of money with I think it's in the Obama administration, they changed the rules around crowdfunding. So now any individual can contribute up to, I believe, $1 million in one campaign.
Mm,
There are companies raising literally hundreds of millions of dollars through crowdfunding.
mm,
Crowdfunding has different sides to it. You could do an equity crowdfunding raise where you're
hmm.
giving people equity in your business. It can be a reward based crowdfunding
Yes.
thing where you maybe giving them a product or service for instead of giving them part of your business. So you can there's a debt side. You can actually do a debt crowdfunding campaign as well.
Mm,
So you could take out a loan through crowdfunding. So there's that. I tell most entrepreneurs don't understand how powerful crowdfunding can be. So I always tell entrepreneurs look at crowdfunding as a potential way to raise capital for your business.
mm.
I've been told from people who have been very successful raising capital through crowdfunding that the most successful crowdfunding campaigns have one thing that it ties them, and that is they are able to create a professional 90 to 120-second video that tugs at the
Okay.
heartstrings of investors, right?
Okay.
So if you had a product or service that, hey, it's, your product or service is something that's going to contribute to eliminating cancer,
Hmm.
something like that. That would I was just talking to an entrepreneur last week who he's using DNA sequencing as a way to predict whether youth would have are prone to injuring themselves depending on particular sport they might want to play
Mm.
as a youth.
That's going to be valuable information. Yeah.
Yeah, and I'm telling him, I'm like, "This is perfect for crowdfunding because I can see a 90, 120-second commercial with a child who's an athlete and talking about how this could be used to avoid him or her having some injury in playing this particular sport that's gonna tug at the heartstrings of parents,
Yeah.
even of other kids that want to play a particular sport." I said, so, that would be an ideal way to raise a capital. On the downside with crowdfunding is because, again, if you think, again, you're thinking about if I'm raising capital from my next door neighbor, does my next door neighbor have a network that they can,
Yes.
if I need funding after this initial raise of capital from crowdfunding, could they help connect me to an angel investor who might be able to fund at the next stage? Chances are no, they're not. So that would be the limitation with crowdfunding. But even then, still for that first round of funding for your business might be an ideal way to go.
No, I love it. I want to circle back. The next thing I want to cover was stages, so that's a perfect segue. But you spoke to something that I would love to be able to get more information out about. Now, you said that there's debt crowdfunding. That's not one that you hear often, or at least I haven't heard often. So I would love to be able to dig into that a little bit more. So I would love for you to be able to go into that in a little more detail because I don't want that to get lost in the conversation that we're having because this may be that sweet spot for some people where they're saying, okay, well, some of the rest of that I wasn't going to be able to use, but this I can actually use. And this one is the one that's most open to most people. Because I know I've been part of crowdfunding based on someone having a really good idea. And then I'm looking at it going, okay, no, this is actually something that I want. And that kind of goes back to wants, needs, nice to haves, guilty pleasures, things like that. If you find something that moves people and they prioritize it enough where they want it, then they may be willing to not only invest in it through crowdfunding, but they'll tell other people about it. And that's where that influence and everything comes in. But that aside, debt crowdfunding, I would love for you to be able to speak a little bit more about it.
Yeah, yeah. So it's going to be you're going to raise capital through a loan, right? So you're going to
Mm,
structure it versus going to the bank. You're going to tell a bank, I need this much money. I can, and they'll say, okay, well, we'll give you this much money, but we need you to be able to pay it back in this period of time, and we're going to charge this much in annual interest. So your monthly payments is going to be, X. And you've either got to be able to pay that or, as I said, have the collateral to be able
mm,
to cover that should you default on the loan. Now, if you go through crowdfunding, you can structure the terms of that loan, right?
mm.
So you could structure it because even when you go to a bank, sometimes they'll say, "Okay, well, we'll lend you $100,000, and in order for this to for you to be able to have a high probability of paying it back, for the first 2 years, we're only going to charge you interest, and then we'll charge you interest and principal after year two." So you could structure this deal. So when you're putting together your campaign, you could say, "Hey, I'm looking to raise $100,000. I can pay it back over 10 years. I can give you back 5% annual interest. But the first 2 years, 3 years, whatever, I'm only going to pay interest on the money, principal and interest." And then you put that out there on this platform to raise capital. And if people find it appealing, they're going to invest. Again, where this is effective is having this, video that
Pairing it
promotes
with,
your
yeah.
campaign that says, this is why I launched this business in the first place. This is the problem I'm trying to solve. And if, you're targeting people that, they've experienced this problem and they want to see this problem eradicated from the face of the earth, they might give you 50, $100, $1,000 to resolve this issue. And you get enough of those people, if you're looking to raise $100,000, you need 100 people to give you 1,000, you know, or you need 1,000 to give you 10, 100.
Right, yeah.
Basically, you're dictating the terms of the loan, and then that becomes part of your campaign. And at the end of the day, you know, what you've got to think about is for the people that would be potentially interested in investing, is this going to be attractive enough? And what may override the attractiveness of the deal is the fact that I'm solving this particular problem. There are enough people out here that are affected by this problem that want to see this problem solved. Maybe while I want to get my money back, that's not why I'm investing.
Yeah, I wanna be very careful about what I say next. What you've described is someone getting something on the back end. So if you're struggling with a GoFundMe and you're putting something out, one, take a look at your story. But two, also look at the fact that, if you're not getting traction that way, maybe switch over to the debt crowdfunding where you can tell people, listen, you'll be able to get some kind of return on that actual investment. This is an investment. This isn't just me with my hand out. So when you said it, that's what I was like, I'm going to wait, but I want to go back to that because I think there's a disconnect where there are a lot of people that think GoFundMe is the only way that they can do it. This is something where you can actually do that, and then this is that natural segue into staging where, you may get that initial investment and it allows you to be able to do that initial thing that you want to be able to do, but that's where staging comes in, and when you get to that next stage of what you wanna be able to accomplish next, I'd love to be able to talk about that as well. So, why do funding stages matter even for someone who may not want to raise traditional capital?
Yeah, I mean, it matters because each stage determines who you need to talk to in order to, again, the people who get funding are the people that match their deal to the people predisposed to do the type of deal they have. Right. So the stage is important because the stage determines is another determining factor of who you should talk to. Right. So if I know what stage I'm at, again, when investors invest, again, they're always looking for return on investment. That they're going to look at the team and the entrepreneur or founder because they want to know, can this person deliver on this promise? They're going to look at the opportunity because they want to see is there traction. But they're going to look at other things. They're going to look at the stage of the business, right? So
Yes.
there are investors that are more comfortable investing in startups, some more comfortable investing in mature businesses, right? Some more comfortable investing in companies that are, ready to do an initial public offering or take their stock public on
Hmm.
one of the major stock exchanges. The investors are going to look at, where are you geographically located? You know,
Yes.
if I invest in a company, more than likely I may at some point want to visit to see how my money's doing, right? So if
Hmm.
I live in Philadelphia and you're in Los Angeles, I might not want to invest in your company because in order for me to check up on my investment, I've got to fly to California.
Yeah.
It's a
Yeah.
5-hour flight from the East Coast each way, and
Hmm.
you got jet lag, and so chances are I'm killing at least 2 days, probably three
Yes.
days, just to
Yes.
visit one investment. That's not practical, right? Whereas if I live in Philadelphia and you're in Wilmington, Delaware, I can drive 30 minutes to your company and see how, and then get back, and it's hasn't disrupted my day, right? So
Absolutely.
investors tend to invest in the same geographic region they're in. And then
Hmm.
last but not least, investors tend to want to understand what they're investing in. So they invest in businesses and industries that they typically come from. If I spent my career as an executive in Ford Motor Company, and I've done very well. I was an executive and left with a really nice pension and made a lot of money because, I invested in the 401k, and now I want to, invest in some startups. More than likely, I'm going to invest in the automotive industry.
Hmm.
I'm not invest in information technology. I may not understand anything about information technology.
Familiarity. Yeah.
I read a business plan for a company that's in the information technology industry. I have no way of telling whether or not you're going to be able to deliver on this, or whether anything you're telling me in your business plan can be done within the confines of your industry, because I don't understand your industry. But if
Right.
the business plan I'm looking at is something to do with the automotive industry, I understand that industry having worked in it all my life. And
Hmm.
so you're telling me you're going to do something because I understand the nuances of the industry. I can inherently tell you can't do this or you can do
Yeah.
that because
Yeah.
I understand the industry. Uh, um, it was a convoluted answer to your question.
No, no, no. It's actually a very good response to the question because the follow-up to that was what decisions today accidentally lock someone into future stages. But it also covers, when we're thinking about stages, we just talked about someone may start with a GoFundMe. They may graduate up to a crowd funding. They may get to another stage where they get further into it. Every time you check that box and you can show that you were able to deliver on whatever it was that you were saying, then it allows you to be able to have that conversation with the next tier up from there. So when we're talking about stages, it's not just your business stage, it's where are you in your business? And if it's something where you needed funding from the get go, and it wasn't something where you actually want to invest any of your own money, but you were able to show that you were able to recoup any investment that someone made, and then they were able to turn a profit. That gets you further into that conversation. When someone flips to that financials section of a business plan, and you're able to say, "Yeah, I mean, I know what this says, but let me tell you what I've done and what the first stage was or the first iteration of this was." And it's like, okay, so people invested in you and they got a return on their investment, then that makes you less of a risk. So I love that you were able to talk about that because we're talking about the progression. And as much as I know that there are some larger scale businesses, I want to kind of give the game to the smaller scale businesses that there are some people who have some really great ideas. I know we joke there is no such thing technically as an original idea, but you can find a great way to take an idea that's out there and be able to turn a business idea into a business opportunity and then turn that into a thriving business. So you don't always need the money. Sometimes you need to be able to have a really good plan. And that's where sometimes, even if you're not that person, if you know someone that has that good planning strategy and they know how to think things through, maybe that's the person to collaborate with, because that person may not want to be involved in the day-to-day business. They just may need to come up with that part. And as long as they know they cover their part and you cover your part, then that is where you can have a strategic partnership. So I love that you covered that because it speaks to the different stages, but it speaks to the thinking process of everything that leads up to each one of them. So yes,
I
yes,
mean,
absolutely.
when you talk about the stages, as I said, at every stage of your company, you're probably going to need financing, right? But
Mhm,
it's going to be a different type of financing more than likely.
mhm.
There usually is not one category of investor that's going to, transcend with you through the entire process. What's going to happen is investor one is going to work with you on stage one. If it's smart money, they're going to give you a lot of advice. They're going to give you a lot of contacts to help you as your business transitions to stage two. And they're going to introduce you to that next, pool of investors that their specialty is investing in companies in stage two. And then that
Yeah.
investor pool is going to do the same thing the people did in the first round for you in the second round to get you to the third round and so on and so forth. So yeah,
Yeah, that's you going from dumb money to smart money and giving context into what that actually looks like, because there are the people that will loan you money, but they don't care about what you have to do in order to be able to pay it back. And then there are the people that are actually not just investing in their money, but they're investing in you and the opportunity. And every time you prove them right, again, I'll go back to what I said. It builds up their credibility. It builds up that logo that they get to say, well, I helped establish this business and this business. Those are things that help them cover what they need to be able to cover. And it allows them to be able to get into rooms where maybe they want to get into another room. And they said, well, you can't get into this room because you haven't helped enough businesses to be able to validate your ability to be in here and do what we do. So sometimes you have to start small and be able to build out these businesses. One of the things that I try to tell people, and this goes back to the corporate side, was they used to say, well, they're not a big enough business and they don't have the budget, so we don't have the time. And my thing is, but not every business starts off as a large, well established business. Sometimes you have to create some to be able to create brand champions and loyalty. So in this case, if you can find someone that's willing to invest in you, if you go through the stages, if you go through crowdfunding, that can introduce you to angel investors and that can get you up to a point where you can start having that conversations with the different tiers within that. And then you can just continue to work your way through it, but it's giving you the credibility along the way. And then the leverage that you have is that you can show that you've been able to live up to everything that you're promising, and that gives that person credibility. So if you're ever in those conversations, that's something to think about. It's not just you with your hand out, it's you giving them a story that they can tell. Because at the end of the day, and you've touched on it, and I will touch on it from the advertising and marketing standpoint, a story sells better than any idea that you may ever have.
absolutely. Yeah, and investing like anything else, because I always tell entrepreneurs, investors are people
Yeah.
just like us, and so it's all about relationships. And
Mhm.
so I use this when I talk about sales, but you can use it for financing too. I'll mention to people that think of yourself as you're the daughter of your parents and you've decided to join Girl Scouts. And now it's Girl Scout cookie selling time and you've got your Girl Scout cookies. Who are you selling your first box of Girl Scout cookies to? Your parents.
Yeah.
Why? Because your parents have a vested interest in your success. They don't want to see you fail. They want to see you succeed. Right. So, and what tends to happen if you worked in any corporate environment, the parents tend to take the Girl Scout cookie sign up sheet to their
Yes,
work,
they do.
and sell the
Yes, they
cookies
do.
for their daughter, and so, whether, whether it's, in sales or in finance, you want your investor. How do you develop a relationship with your investor so they think they're your parent, right? And they treat you accordingly,
Yeah.
right? So
Yes.
you want them to have a vested interest in your success. You don't want them to just give you money. You want them to give you advice. You want them to open up their network of connections to you so that you can, find suppliers easier and get better deals with your
Yeah.
suppliers. So you can get customers easier. So you can create strategic alliance partnerships with complementers and competitors, right? The relationships they have, that you want them to bring you into these relationships to help your business, scale, right? And so if they, if they view you as their child, their Girl Scout cookie selling child, they're going to do that for you. And
I
you know,
love the framing of that, yeah.
so it's all about business is all about relationships. And at the end of the day, you talked about it earlier, it's business is common sense, right? And if you thought about what you did when you were younger, in your neighborhood to survive, and you applied a lot of common sense, right? Business is the same way. Those people are going to be more successful than the people that think they know how business runs. We overcomplicate this.
Yeah,
It's not
yeah,
rocket science. It's common sense,
yeah.
and common sense
Well, I
works.
mean, you know the follow-up to that. Common sense is not common, so,
Yeah, yeah, yeah.
yeah, we can bring it back around to that, but at the same time, frame it in a way. I love the analogy because the analogy covered the parts where you may not have common sense, but you have good sense. And good sense is a survival instinct. And it's something that you can say, well, I know where I fall short. I know where my limits are. I know who doesn't have these limits. And you start to look for ways to be able to bring people into that. So I love the Girl Scout analogy because that is very much what it is. And what you're really looking at in these situations is this is why I loved more of the account management side than the sales side, because anybody can sell something once. I wanted to be on the side where once you made the investment, that like now there's nowhere for me to hide. Like I have to be able to deliver on what it is that I'm saying. So for me, that's where the real challenge was. And I think that's part of what we're talking about. There's anyone can lend you money, but what you're really looking for is someone that's invested in you and what it is that you're doing, because those are people that will make introductions. Those are people that will get you in rooms that you may not be able to get into on your own. And then realistically, I mean, I'm old school. I don't want someone to make an introduction until I know that I'm able to live up to the expectations of what that introduction would get me. But, I'm a little bit different. I don't expect me from other people, but I will say these are the things that we're talking about. You want people that can get you into these rooms. These are the strategic partners. Like they're not just giving you money, they're giving you invitations to be able to have conversations that you would normally never have access to. And that's where we see people end up evolving. And that's the importance of strategic partnerships. There's a lot of people that want to be the hero, but the real heroes are the people that are working behind the scenes that can make those introductions. Those are the people that will say, "No, trust this guy. I have my reasons." If you take it back to the Girl Scout analogy, I know how many different times I've been in an office. I know how many times I've given my mother candy for her to be able to sell. My mother worked in data processing. There were people that were like, "I need my reports." I am not going to run the risk of alienating you by not buying candy, and then all
Right.
of a sudden my reports could come in late. Mom, I know you would not do that, but you get where I'm going with it. You get to leverage other people's leverage when you're in those situations that you would never be able to do on your own. We didn't just talk about the business model, we talked about the business plan. We talked about what the process looks like. Even if you're starting from scratch, you can go with GoFunding, you can go to crowdfunding. These are the latter steps that you can take to be able to do some of these things. And then we just segued into uh, who and how to start deciding who you want to be able to work with. So that once again is a great lead in to what I want to be able to ask you. So why is comfort a signal when structuring a deal, and how do you listen to it without actually letting it run the process for you?
Yeah. So, I mean, this all ties back into the business plan, right? And
Mm,
the financial section of the business plan, because the financial section of the business plan tells you what your deal is, right? So, when you're doing this, and I think I had mentioned this to you, I tell entrepreneurs to always start with an assumption page, right? Always
yes.
when they're building their financials. Um, uh, you have a certain set of assumptions. At the end of the day, you want to understand, what am I going to spend, what money is going to come in, and where is it going to come from, and all that good stuff. But in the grainiest level of detail possible, you want to lay out, what assumptions am I making about revenue? You know,
Hmm.
what are my products? List all my products. But what am I pricing my products at? Right? Who am I selling my products to? How big are those markets? What percentage of the market am I getting? How many sales do I think I can make on a daily basis? Am I discounting, the product, and what's the discount rate? And, what percentage of my products do I have to discount? And all these types of things, so that, those will be under your revenue assumptions. Then with your expense assumptions, what, who am I hiring? What role are they going to be in? How much am I going to pay them? Am I giving them bonuses? And what taxes do I have to pay for them? Um, what other benefits do I have to provide them? What are they going to cost me? What supplies do I have to acquire to run this business? Am I going to have a facility? What's rent going to be? All of these things get laid out on your assumption page, right? And then from that, it builds your set of financials. And where this is important is when you start to talk to an investor, you want to discuss assumptions. You don't want to talk financials, right? Because at the end of the day, if I agree on your assumptions, I'll agree on your financials, right? And the financials will tell me what type of deal that you have.
Mhm.
So if I agree on all the assumptions and agree on the financials, then I'll agree on the deal. If I question something in your financials and we can go back to the assumptions that I made to that ultimately ended up giving you those numbers. We have a discussion about the assumptions. For instance, you know, I'm going to hire this person and pay them this amount of money. And the person says, well, I don't believe you can hire a person at that rate.
Yes.
And he said, okay, well, how much do you think I have to pay for this person? Oh, I think you have to pay them 10% more than you're anticipating because that person isn't in your local area. You might have to get them from another area. You have to relocate them so that, so on and so forth.
Mhm.
So you might have to pay 10% more than you're anticipating. Okay. Well, let me change that in my financial model. Let me increase that rate 10% and then recast my financials. And
Right.
then now look at the financials. Is this a doable deal still? Right? If it is, then we should be able to move forward. It's different than having just going in without the assumption. Now I'm just going to show you 5-year projected financials. And then let's say you have a question about, something. Hey, how did you come up
Mhm.
with, this particular salary item? Now I got to remember how long ago did I create this, these
Yes,
financial
yes,
statements?
yes.
Maybe I created it a year ago because, chances you might be raising capital for years, right? So
Mhm.
if I created these set of financials a year ago, am I going to remember how I came up with this one number? Chances are
Yeah,
no.
yeah.
But if I have an assumption page,
It's your cheat sheet.
yeah, and someone asks that question, all I have to do is go back to the assumption that led up to that number, and then I say, oh, okay. I said I was going to hire this person. I was going to hire them in this month. They were going to try. They were going to cost me this much in salary, this much in
Mhm.
benefits. Okay, that's how I came up with that number.
Yes.
So
Yeah,
now you can
yeah.
have intelligent discussion.
Yeah, I so much to unpack in that.
Yeah.
One, I know some people will hear assumptions and they just think of the negative connotation to it, but the assumption page is a thing that allows people to be able to see, like it's a math teacher says, show me your work. There are a lot of people that can come up with the numbers. The other thing that I want people to understand is the importance of having someone stress test the assumption page. Because that goes back to what we were talking about when you sit down with someone and you start to have that conversation with an investor, the people that really care about you are going to test that assumption page right off and they'll tell you, yeah, this isn't good. Like your numbers don't line up. These assumptions that you're making, here's why this doesn't work. That's where you get the answers. That's where you start to check the boxes to be able to go, yeah, I didn't check this box. I didn't check this box. So the next time you go to have that conversation, it goes back to what you said, it's not often that you're going to have that conversation with one investor and you're going to get that investment that you want from that first person. So this is where you have that conversation with people and you start to stress test it. Am I looking at this the right way? And the right people are going to tell you, well, here's the blind spot that you're missing. And then you come up with iterations, you fine tune it. So by the time you go to get in front of the person that you really want to be able to have that conversation with, you've gone through those iterations and you're able to ask the follow-up questions. At that point, they turn into frequently asked questions because you've been presenting it so much that it's something that when they go to bring that up, oh yeah, I thought about that part. And here's what I'm basing that on. The other thing I think that is really important is time frame because everything continues to evolve. So what people are getting paid at the time when you first started thinking about something, it doesn't line up with what they expect to get paid at another time. There's employers markets, there's employee markets. Like you have to understand like when you're having these conversations because I know from the corporate side when it was an employees market, oh, these companies had to be able to empty their pockets. I mean, we're going to give you extra week off for vacation. We're going to do this. They had to sweeten the pot. But like these days, with them scaling back, it's going to give you context. And context is what you need in these situations to really be able to figure out how to be able to have the conversation with the people that you want to have it with. And that's what gives you more leverage and more negotiating power because they can tell when you've given it that level of thought. So when you go through that thought process and you go through that exercise of stress testing something and they're asking you questions, you get to see their thought process. You get to see how their mind works. If you're paying attention, and I'm someone big on pattern recognition, you're going to see signs of something. And once you see that sign, if you see it again, then that lets you know that it's a pattern. It doesn't always have to be with that same person, but if you start seeing people asking you the same questions or different variations of that question, then that means there's something that's still going unaddressed or that you're not articulating in a way that you want to be able to articulate. But then you can also tell when you start to get those red flag questions and you're like, okay, now you're telling me what your agenda is based on the question that you asked me. So it's not just something where that person's learning about you, you get to learn about that person. So pay attention when you're having these conversations and document these things because when you document these things, you can go back. And I mean, this is part of where AI and all the rest of that stuff starts to kick in. AI can give you this is what a perfect scenario looks like. Where you get the context, where it can actually start giving you better advice is documenting some of the things that you see along the way. So if you have a conversation, you realize someone says something and it didn't sit well with you, and you're able to go back in AI and say, yeah, I've had like three people ask me this question. It didn't sit well with me, but I didn't know why. I may actually be able to go in and say, yeah, I mean, you didn't know how to name it, but let me put a name to it. This is why this didn't sit well with you. This is what this leads to. And this is why that may not be the best deal for you. So there's a lot of different things within that. Those are those learning moments. It's why I say there's a difference between people that are book learned and then the people that have life experience. Because book learned, AI learned is going to tell you the perfect scenario, but it takes living through those moments to be able to go, yeah, I mean, I know what it told me. I know what the book told me. I know what AI told me. And then when I went in and I tried to present it that way, it was like, okay, well, what about this? And what about this? And what about this? And that's where you get the context where life actually steps in and it intercedes and it forces you to be able to have the context that will allow you to get able to get further and further into those conversations. I can't thank you enough because we have covered different stages of the business journey. I think if anything, if nothing else, between understanding the importance of a business model and then doubling down on here's why it matters
Yeah,
is
yeah.
enough for people to be able to say, okay, I got to figure some stuff out. So, okay, well, if there's one thing that you want someone to remember from this episode, there's so many. What would you like them to be able to take from this? We can talk about the money, we can talk about how things should be, the progress. If there's anything that you want someone to be able to take from this, what would you say that would be for you?
Yeah, I would just tell any entrepreneur, the more you can learn about the financial industry, financial services industry, and how it works, the better off you're going to be. You don't have to
Mm,
be, you don't have to have an MBA in finance. You don't need to understand it to that level. But it's just the more you understand who are the players, how do they think, what can they lend, what do they want back, how can they help, how can they hurt. The more you can learn about all these nuances about the industry, it's only going to make you a more powerful entrepreneur and stronger entrepreneur.
okay. Well, with that, this is not my expertise. I know what my expertise is. So I like this is why I wanted to be able to have you on. These are conversations that you're having with people. Please tell the people more about how to be able to get in contact with you, how to be able to have these conversations and not just just having the conversations, but a significant conversation that moves the needle. I know you've got your university, there are different things that you're doing. I'd love if you would tell people more about it because there's nothing like getting information and then not knowing what to do with it. You're actually giving people ways to be able to not just get the knowledge, but figure out how to be able to take the next steps with it.
Yeah, so the easiest thing for them to do is to go to my website, which is www.thinkbigwithjeffreykent.com. As
Mm,
you can see on the screen, my name Jeffrey is spelled with a G. It's the old English spelling of Jeffrey. So that's the easiest way to connect with me. One resource that I have is I have a group on alignable.com called Entrepreneur University. So I host weekly events on Tuesday evenings, 4 p.m. Eastern, where I set up opportunities within an hour for entrepreneurs within the group to meet each other. Entrepreneurs are welcome to join that. You can get a free membership from Alignable. Join the group for free. The events are free. Uh, you know, it's just a support community for entrepreneurs. So that's another way. So I would say either, you know, go to the website, where you can directly connect with me or go to the Entrepreneur University group on Lineable. You'll still be able to directly connect with me, but it'll be through my networking event. So either one of those two
Got it.
ways.
Got it. Well, thank you for that because there's nothing again like getting information and insights and then going, okay, all of it sounded great. I'm motivated. I want to be able to do something. And then when the lights go off and you have to get back up the next day and try to recreate that situation, it's not as easy as it seems. So I want to make sure that people know where to be able to continue having that conversation. Okay, so with that, I'm going to bring it back around and say if the idea of taking money makes you uneasy, owing people, reporting to them, or dealing with the headaches that come with it, you're not wrong to be cautious. This episode wasn't about convincing you to raise money. It was about helping you understand when money helps, when it hurts, and how to avoid deals you'll spend years unwinding. So I hope that we were able to cover that. I think we've covered the different stages of it. And with that, I will say thank you so much and like, share, and subscribe. And we will see you next time.
Thank you.
Thank you for tuning in to the Strategic Thinkers Podcast. Remember, when you can make the inconvenient convenient, people are willing to pay you for the experience. The better the experience, the more they'll not only pay you, but help others pay you. Serving as brand champions. My name is Sean Atkinson, and I'm wishing you well on your journey to your definition of success. If you find this podcast interesting, helpful, worth the listen, like, share, and subscribe. Leave a positive review so people know to check it out, and I'll see you next time.